What we've seen over recent years amongst planners and the end investor is a gradual and increased move towards fixed cash and fixed income type products.
Many investors have seen some very strong returns from fixed income over the last 3 or 4 years as government bond yields have fallen to multi-decade lows.
But advisors around Australia are being forced demographically to deal with their clients' decumulation phase. And income is very important in that phase, for something that's very important for retirement. And no doubt we've seen capital appreciation across bond funds recently as yields around the developed world have fallen.
Yeah, the need for diversification is crucial. It's the first thing portfolio managers, as we're training them in this asset class, get taught. And it's essentially that a bond's price can't really rise in value, but it can fall a long way. And so we need to adequately diversify across not only government bonds and corporate bonds, but a whole range of different industries and individual companies to have a portfolio that's of investment grade quality. And that role of diversification, we think that many investors, when they're thinking about how to do this asset class in their portfolios directly, are using a combination of term deposits and perhaps some listed or hybrid securities. And that's ineffectual diversification, we believe, because those portfolios will have more growth-like risks when the cycle's turning down.
We've seen such a recent spate of issuance in the subordinated notes or hybrids from many corporations or companies around Australia in recent times. And one thing that we've been out there talking to clients about is to ensure that they have ultimate diversification within their bond fund. All different markets will be operating differently at different times. And when we construct a portfolio, whether it be Australian or global, we make sure we have 100+ securities that will all be operating differently at different times. For example, credit versus government securities.
There's a fair amount of evidence around that would actually suggest that these instruments need to be approached with caution.
Amongst the advisor community, no doubt fixed interest has been the often misunderstood asset class relative to domestic, even global equities, as clients have often held term deposits as the provision of their fixed interest needs. But I think over recent history and the capital appreciation that has occurred across bond funds, something that term deposits just cannot do, has really showed the diversification benefits a bond fund can have in an overall asset allocation.
Yes, we think in today's environment that many investors are able to approach equities as an asset class much more easier than fixed income. That's because of their degree of familiarity with stocks is much higher than with bonds. Really in today's environment, we're seeing really that knowledge gap is in the area of how much diversification you should seek within your fixed income portfolio.
You're fundamentally taking a credit risk on the underlying issuer, and what we're starting to see is with reducing official cash rates, people are searching for income via a different mechanism.